This month, one investment wiped over £4,000 off my portfolio. And rather than selling anything, I actually added nearly £8,500 to two other holdings. And despite global stock markets continuing to push higher, I'm still running a portfolio that's positioned very differently from most investors. So in this update, I'll show you what happened in June, what I bought and why I remain comfortable with such a defensive portfolio. My portfolio now stands at just over £897,000. In June, the total value fell by £1,466. But because I added £1,410 during the month, the portfolio's actual investment return was a loss of £2,876 or 0.3%. This chart shows how steady the portfolio was during June. It moved slightly higher at the start of the month before drifting lower to finish down 0.3%. Global equities had a much more volatile month. Early on, markets fell sharply as tensions in the Middle East escalated and investors became concerned about the potential impact on oil prices and the wider economy. But those fears eased as the month went on, and markets recovered to finish up 0.5%. My portfolio didn't experience those swings because it's positioned very differently from a traditional equity portfolio. Finally, inflation, measured by RPI, rose 0.2% during the month. In terms of what moved the portfolio this month, Jupiter Global Equity Absolute Return was the best performer. It rose 2.2%, which added just over £500 to the portfolio. But by far the biggest drag to the portfolio was gold. My gold holding fell by over 10%, which knocked just over £4,000 off the portfolio. Without gold falling 10%, my portfolio would have been positive for the month. Jupiter Global Equity Absolute Return has now been my best performing holding for the second month in a row. It's a long-short equity fund, which means the manager owns companies they think will outperform, while also shorting companies they think will underperform. The latest fact sheet shows it's almost market neutral, with around 98% invested on the long side and 98% on the short side. That means it's not relying on the stock market rising to generate returns. Instead, it's trying to profit from the gap between its strongest ideas and its weakest ones. You can see from the fact sheet that it's invested globally. At the moment, it's particularly positive on parts of the semiconductor and memory sector, with companies such as Samsung, SK Hynix, Delta Electronics, and Taiwan Semiconductor among its largest long positions. This is exactly the type of holding I like in my portfolio at the moment. It has the potential to generate positive returns without needing a bull market, which fits well with the defensive positioning of the rest of my investments. Gold was by far the weakest part of the portfolio this month, falling just over 10%. But this isn't really just a June story. As the chart shows, gold had a very strong run into March, and since then it has been steadily giving some of that back. I think there are a few reasons for that. Some of the fear trade has come out of gold, with investors becoming more willing to take risk again as equity markets have pushed higher. Interest rate expectations have also moved against gold, because when bond yields or real yields rise, gold can become less attractive as it doesn't pay any income. And after such a strong move, some profit taking was probably inevitable. I did think about topping up the position this month, but decided against it. If we do get a genuine liquidity crisis, gold can fall in the short term as investors sell liquid assets to raise cash. So I'd rather keep some dry powder available in case a better opportunity comes. But my overall reason for holding gold hasn't changed. I don't own it because I expect it to go up every month. I own it because it behaves differently from shares and bonds, and because it can provide useful diversification during periods of inflation, currency weakness, or financial stress. Year to date, the portfolio has generated just over £56,000 of investment return, excluding contributions. That means it's currently up 6.7% for the year. Now, compared with global equities, which are up 11.6%, that is obviously lower, but I'm also taking significantly less risk. And compared with inflation, which is the main benchmark for this portfolio, the picture looks much stronger. RPI is up 1.7% so far this year, so the portfolio is comfortably ahead of inflation. And my longer term aim is to beat inflation by around 3% a year, rather than simply trying to match global equities. This month I made 2 purchases. The first was a small top-up to BH Macro, which is a global macro hedge fund. The share price had recently fallen and the discount to net asset value had widened, so I felt 421p was a reasonable opportunity to add a little more. Since then, the share price has moved back up to around 427p, so the timing has worked out well so far. But this was only a small top-up because BH Macro is already quite a large position in the portfolio. The second purchase was iShares TIPS ETF. This was really just a dividend reinvestment. The fund had paid out roughly $3,400 and I reinvested that back into the same fund. TIPS are short-dated US government inflation-linked bonds, so they continue to fit with the defensive inflation-aware positioning of the portfolio. The overall asset allocation is broadly unchanged, and the portfolio remains very defensively positioned. The reason for that is simple. I still think valuations, particularly in equity markets, are expensive. At today's prices, I don't think investors are being adequately rewarded for the amount of risk they're taking. Could markets continue to rise? Absolutely, but I don't think the potential reward justifies the level of risk. So rather than chasing markets higher, I'm happy to stay patient. Around 40% of the portfolio is in cash and short duration bonds. These provide a steady return and, importantly, give me the flexibility to buy more risk if prices become more attractive. Around 32% is invested in short duration inflation-linked bonds. I still don't think inflation is fully back in the box, and I think there's a good chance it remains higher than many investors currently expect. Around 25% is invested in defensive and absolute return strategies. These investments are designed to generate positive returns without relying on equity markets continuing to rise. And finally, around 4% of the portfolio is invested in gold. Despite this month's fall, I still think it has an important role to play by providing diversification and helping to protect the portfolio in certain economic environments. My top 5 holdings remain unchanged this month. The largest position is still a Mundi Smart Overnight Return. It's essentially a money market fund that closely tracks the Bank of England base rate, and it provides a steady return while also giving me plenty of liquidity if I want to take advantage of better opportunities in the future. I also have 2 inflation-linked bond holdings in my top 5, iShares TIPS and PIMCO Global Low Duration Real Return. As I've mentioned throughout this video, I still think inflation remains a meaningful risk over the coming years, so these continue to play an important role in the portfolio. BH Macro remains one of my largest positions. I topped it up slightly this month, taking my holding to just over 121,000. It's a global macro hedge fund that aims to generate positive returns from macroeconomic opportunities, regardless of whether equity markets are rising or falling. And finally, I have a holding in the UK Treasury 2027 gilt. It's a very short-dated UK government bond, which gives me another safe place to hold capital while earning a modest return. Looking across the top 5 holdings, I think they sum up my investment approach quite well. They're all focused on preserving capital, managing risk, and giving me flexibility, rather than trying to maximize returns in what I believe is still an expensive market. So that's the June update. The portfolio was down slightly, mainly because of gold, but year to date it's still generated over £56,000 of investment return. Thanks for watching, and I'll see you in the next one.